And so that brings into play the threat of a late freeze.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. I'm joined today by Joe Camp. He is with Comstock Investments. We're going to take a look at the market action at midweek here on a Wednesday. And it was a pretty sour day when you look at the grain markets. A lot of red on the screen. However, Joe, by the time we got to the closing bell, things were coming up well off of the lows. In fact, looks like Kansas City wheat actually turned around and closed in the green. The other market's still struggling, though. So what do you make of all that choppy action today?
It's a market that's starving for fodder for the bulls. I mean, just negative news abound, but yet still the suggestion that by and large, this break lower on grain prices has been a product of speculative liquidation rather than an outright reversal of those previously held bullish bets. And so fresh selling interest, at some point is triggered by all of these news headlines and can be further triggered if the technical momentum continues to build on the downside. But that was my take on it, was that it's more liquidation, and then you don't have a follow through seller necessarily through the rest of the session, and you can then pair the losses. But we need something new to be injected into this market to actually allow things to turn around. And it could help that we have, like we do today, some semblance of a rebound recovery for the stock market, stability, relatively speaking, for crude oil after it's been on a slide lower, and the dollar index just slightly higher, more focus about how sharply lower that greenback has been falling to the possible support down the road of commodities as a whole. But again, just looking for something out there. The bulls are in an obviously consistently bearish type of news cycle that we're in.
Unfortunately, this is always the time of year where the export demand always drops off anyway. And I don't know if the lower dollar is going to help a whole lot at this point in the year. Kind of interesting. So we did have the corn come back about a nickel or so off of its low of the day. But when you look at how things ended the trading session, did we do any technical chart damage on the corn or the beans?
We did, in the sense that we're right back below the 100-day moving average. We're still seeing those major moving averages drift lower, the short run studies dropping below the longer term moving averages to indicate a bigger turnaround here that's been developing. And it looks like it's a market that's heading right back down towards old lows in a continuation of these bigger primary trends that we've been in. We think about the last couple of months worth of strength, a bit more than that for corn since the August low. And the idea was that this is a bullish trend, but it's a secondary trend. Is it one that can flip the overall bearish primary trend into something positive long haul? And now the indication seems to be likely not. And for that reason, we're bringing about these really key major lows, like on the continuous chart, 360, where we bottomed out for September futures in late August. For soybeans, you have a recent low around 955. Below that, nearby chart down to 936. If we talk about even bigger lows, it's not much until you get down to 2019 at 780 for the beans. For corn, those lows back in 1819, just above $3. And so that's a really bearish scenario, of course, but one that can't be ruled out if we are, in fact, in an Elliott type breakdown towards new lows. That has to be one of those scenarios we factor in when we're managing risk here, that just everything stays sour, that sentiment does not turn up, and that we don't have any relief just yet on what is squarely bearish attitudes about the economy and about the risk factor that all markets have at this period. So I guess that's the big bear case out there. The more bullish short-term look would be just simply starting to retrace more of this latest drop down from what was just recently, like for corn, a 1-year high up around 518. If you get up to 480, talking about a 50% retracement, you can get in the into the Fibonacci levels up to around 490. 490 to $5, certainly you're going to find pushback, I would expect, on the charts. And so that's, at least for those waiting for their next selling opportunity, some targets that we could circle. For the beans, those similar retracement levels are about 1140 and 1150. And so, if that's the best we can do in the short run, we're going to have to be prepared to take advantage of it.
Do you think the spread between the nearby corn and the new crop corn is going to change very much with the thought that we're going to have a lot of acres this year?
I think it's going to stay volatile. We observed the bull spread on the way up with the May contract leading. That really opened a premium for the nearby. That can shift back to being a more bearish looking spread like we've had lately, where the new crop contract's down, but it's generally holding around this 450 mark, where we've just talked about much lower types of targets, where this nearby corn market could spiral towards. And that's if we have continued speculative selling, liquidation, or fresh short interest. That could actually lead the nearby contracts lower for a while, despite what you bring up, which is the more bearish look at higher corn acres going forward. Eventually, that can be something that flips back again into more of a bull spread scenario where the old crop contracts suffer disproportionately because of whatever we learn later this month. And that's where I'll bring up whatever the reaction might be on the spreads. That will be a key point of interest following the March 31 grain stocks and prospective plantings report, because it's not only a look at what might be planted for the new crop, but it's an update on what's left available from the old crop, especially if that would show that we're using corn, for example, really strongly, like we seem to be, that there could be less left over on the grain stocks, yet still plenty of acres planned to be planted for the season ahead. And that could, again, shift the relative spread out wider.
Yeah, it's a very good point. Again, that's coming up March 31st. That'll be out at 11 o'clock in the morning Central Time. So we look forward to that. They are talking a lot of storminess in the U.S. the latter part of this week. And it's really going to get in gear when that low comes out of Colorado and enters the plains, and it'll pull up that Gulf moisture. And it looks like we're going to have just all kinds of severe weather in the south, rain in the center, maybe blizzards in the northern plains. It should go across the Midwest. And it leads me to believe that we're going to have plenty of moisture for the spring planting season in the Midwest. However, it seems like it's missing kind of a goose egg in the southern plains. And they're predicting dust storms, dirt storms again, extreme high fire danger indexes again. Boy, that sounds all too familiar to a few years ago.
Yeah, everything from like last week, blizzard warnings, as you mentioned, in the north, down to red flag warnings and the risk of drought spreading as those southern plains states again miss out. That's, of course, the continued consensus generally for meteorologists that's the way that at least the spring could lean, is very dry in the southern plains and into the southwest states, but chances for precipitation elsewhere. And when you have that split, it's more of this dichotomy between it really looking like spring in some places, but then other areas being reminded that winter's far from being over yet. And it brings up another weather risk that I'm watching in the short run, and that's this so-called sudden stratospheric warming that's occurring, the part of the stratosphere that's connected to the polar vortex, which is about to leave us for the summer. Although what we can see is with that warming of the stratosphere, it can break down more severely and quickly the polar vortex and adjust the jet stream so that we still have that cold Arctic air able to be pulled down into the U.S., maybe for up to a month after the initial breakdown of this polar vortex like we're seeing now occur. And so that brings into play the threat of a late freeze. And not only is that something we think about for the early planting season around the Midwest, but back down in the southern plains there, if it's dry, and then they're going to be threatened by late frost or freeze, we do have a trouble spot on the winter wheat crop potential going forward. We did observe that recently. Kansas and Texas, their winter wheat crop conditions on a decline here, and with the outlook ahead, it's not painting the most positive picture. As mentioned, Kansas City wheat futures able to flip positive here by the close, and some of this weather factor being priced in pretty early ahead of what we know is a big weather market usually coming up into the early months of spring.
Well, as we turn the page over to livestock, they had one heck of a day over there to the upside. But I wonder how much that forecast of the dry conditions in the southern plains really propped up that cattle market. I see where feeders look like they made another new high.
Just when we thought we'd be in a year where we could gain traction on rebuilding the herd, in part because of improved pasture conditions, you have this outlook for continued drought. This coming off of last year, we thought, okay, improved pasture conditions in a lot of places. This could be the first step. Prices the way they were, the uncertainty still generally slowing and not picking up on the retention rate. And we're left in now the same spot where maybe we were a couple of years ago, where that Southern Plains was coming off of at least 3 seasons of really dry weather in a row. And so you have this doubt again about being able to expand cattle numbers over the long haul. It's only exacerbated by these tariff news and the headlines that would lean more friendly for the cattle than any other market. That's been evident when you have these upside runs while other markets are going lower amid the headlines about tariffs. You could further block this flow of feeder cattle from Mexico. That's pertinent too, right? For feeder cattle that would be coming into the U.S. South, the U.S. Southwest. If it's going to be dry down here, that's going to be another bit of pressure for those flows, which are already crimped for another reason. And that's because recently the border being closed because of the New World screwworm problem. So those are more supply side pressures that support this higher move on the cattle. And it's a market where, when everything else is negative and uncertain, when the stock market's selling off and the grains have the negativity related to tariffs as well and the technical bearishness, the cattle are one spot where, well, we're making new highs, where the funds are still long and they want to defend and add to their positions. It's a market where some money can flow in, and you don't have such the quite negative ramifications overhanging everything like so many other markets do right now. But yeah, new highs for the last couple of weeks on live cattle and new contract highs for feeders today.
And then when you look at lean hogs, it's like they were sitting on the sidelines watching the world go by. They didn't accomplish much of anything today. How come?
No, there was this thought that we would see some upside movement with all of the worry about the economy and pork, the so-called recession meat. I was talking to David about that, and the thought that with cattle going higher and beef staying strong, that you'd have to have spillover support there. Well, we did have a bit of a run up here earlier this week and last on the hogs. We've just stabilized, though, with, I think, greater uncertainty, where we talk about the tariffs being possibly friendly in ways for cattle. They're not so much that for the hogs, considering how important pork exports are, relatively speaking, for the portion of hog production and the overall demand profile for that market. So it's a market that's more like the others, like the grains, where tariffs give hog traders pause for sure.
Well, one thing that makes me wonder, though, is when you look at the recent movement of the equity markets just collapsing here in the last, what's it been, 3 weeks or so? And yet the cattle market seems to be hanging right in there. I mean, to me, that's really, really impressive that it can do that. But I don't know how long it can fight that.
Yeah, I think you have to think that those supply side bullish issues are right now offsetting any future worry about demand, and the current demand profile still looking resilient. The way we have seen beef stronger, slightly higher in today's morning cutout report, and generally not the type of pushback yet that we'd expect at the retail level or the restaurant side of things. And I think that again flips back to just being a function of supply, that we've been so short. It takes a lot to rebuild stocks. And as we know, we're entering the spring and summer season pretty quickly. The thought is that it's still a supply side constraint that leans more bullish there. And then again, generally, if you normally have that spreading against the lower stock market, it can be, at least briefly, temporarily, a matter of money finding a home. Again, not having that interest in the grains right now, not necessarily the positive storyline for hogs. And so it's return it to where those speculators, those investors have been long in these cattle markets.
Well, great insight into the markets, Joe. Good to visit with you again. Thank you for all that. Appreciate that. Joe Camp with us from Comstock Investments. That'll do it for this episode. We thank you for joining us. For producer Brianne Jenkins, I'm Marlin Bohling. We'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.